We got some breaking news, guys. The end of high interest rates may be here. And if that's the case, what does it mean for you as an investor? What does it mean for you if you own real estate? What does it mean for you going about your day-to-day life? We're going to break it all down and go over 5 key things that you need to know. You don't want to miss today's video. If it's your first time here, my name is John Boyd. I'm a certified financial planner, and I'm the founder and lead wealth advisor at Modern Wealth. If you like today's content, be sure to hit that like and subscribe button so that you keep getting content just like this. And of course, if you need specific financial advice, reach out to us at www.modernwealth.com. So the Feds came out today and announced that they were not raising interest rates and are actually planning on keeping the Fed funds rate at around 5.33%. But here's the interesting part to all this. When the Feds meet, part of their meeting process is that each member of the FOMC provides their personal belief on where interest rates are headed. And you can see this information on the Fed's dot plot. So you can see here that as of the December meeting at the end of 2023, it is a unanimous decision to keep interest rates where they are. And you can see those different members of the FOMC represented by these little dots. But here's what got markets going crazy and why you are even watching a video about high interest rates coming to an end. It's because look at here for 2024. Most members of the FOMC believe the effective Fed funds rate in 2024 will be closer to 4.6% instead of 5.33. So what does this mean? This means that we could be in store for not just one, but multiple rate cuts in 2024. And as you can see in future years, those rates are projected to continue to drop. So how does this impact you? Here are the 5 key things that you should know. Number 1, nothing is set in stone. The Fed dot plot is merely a projection on where the Feds think rates are going. It doesn't mean that they have committed to anything contrary to some of the content that is out there. Well, yes, inflation is going down, and that's one of the main reasons that the Feds have kept interest rates high in the first place. They haven't committed to actually doing anything. Feds could certainly change direction and just keep interest rates where they're at for longer. And if they do, we could potentially see stocks sell off. As a result of that, we could see mortgage rates remain higher, among other things. So bottom line, it's exciting news, it's promising, but nothing is official. Number 2, if the Fed funds rate falls, that means interest you earn on cash laying around is going to be a lot lower. A lot of folks out there have gotten really cozy by having a lot of cash sit in high yield savings accounts or even short-term treasury. If the Fed funds rate drops, you are going to see rates much lower on cash equivalent investment vehicles, which leads me to my third point. And that is if your investment portfolio requires an asset that is going to give you some stability, good old-fashioned bonds could be a beneficiary of rates dropping like this. Let me explain. The reason for this is that the price of bonds are more linked to what happens with the 10-year treasury. And why does that matter? Well, because the 10-year treasury moves ahead of what the Federal Reserve does. And the 10-year treasury is effectively the pulse of the bond market. The bond market prices in future events. And it's a big reason why the 10-year treasury on the cusp of all this news fell from 4.2% all the way down to below 4%. And when rates fall like this means that the price of bonds generally go up. It's a big reason why the S&P 500 investment grade corporate bond index is up over 5% in a single quarter in Q4 of 2023, and the quarter isn't even over yet as of the recording of this video. So bottom line is investing doesn't have to be so black and white. It doesn't mean that you just have to sit all the way in stocks or all the way in cash. There are opportunities to make money in other areas, especially in this interest rate environment. The fourth thing that you should know is that with lower interest rates, this means more opportunities for individuals who own real estate or who are interested in buying real estate to take advantage of cheaper financing. Similar to how the bond market works, mortgages work in a very similar manner. The mortgage market might start to price in lower mortgage rates before the Fed even does anything. So if you are someone who just bought a house and got a 30-year fixed mortgage, let's say in the high sevens, it might behoove you to be on refi alert, since mortgage rates could potentially fall into the 6% range by early 2024. And they could even be closer to 5% by the end of 2024. Again, I'm not saying that's going to happen, but it could potentially happen if the bond market and the mortgage market prices in these future cuts. The fifth thing that you should know is how this impacts the economy. What does this all mean in the first place? Why are rates going down? Well, as a refresher, the Feds increased interest rates because inflation was too hot. Inflation was a problem. And so they increased interest rates to help water down how bad inflation was getting. Well, now inflation is really starting to cool off. But when you think about how they make this happen, right? What are the impacts of higher interest rates? Well, higher interest rates generally mean that it's going to choke the economy. It's going to slow things down. And so if the Fed is lowering interest rates, that means that the economy is ultimately slowing down. That's why a lot of people think that we could be heading to a recession very soon, and that the impacts of these higher interest rates are not yet to be fully seen yet. In other words, the economy could be in a lot worse shape than it is right now. And again, if that happens, that could impact lots of people, and of course, could potentially have some negative implications for you as an investor. So bottom line, guys, all of this is really exciting news. It's definitely something to keep in the back of your mind. Again, nothing is set in stone, and it doesn't necessarily mean that just because rates are going to continue to fall, that we're going to have, the market rally 30, 40% as a result, right? I mean, could happen, but again, be cautious, tread carefully. So there's your quick rundown on the state of interest rates. If you like today's video, be sure to like and subscribe. And be sure to leave your comments on what you think is going to happen with interest rates in the comments below.